accounting. She has wanted to be an accountant ever since middle school. She holds a BS in accounting from Virginia Tech, a Master of Accountancy from the College of William and Mary, and a PhD in accounting from Virginia Tech. She also holds an active CPA license. During her undergraduate years, Dr. Burke interned at PwC and Anderson in audit. And after earning her master's degree, she went on at Anderson in corporate tax, where she performed a 40-year earnings and profit study. She did corporate tax returns, partnership tax returns, and exempt org returns. After Enron, she went to work at a regional accounting firm where she specialized in high net worth individual taxation. Her clients had $20 million or more in investable assets, or they were in the newspapers on a daily or weekly basis. She has done individual tax returns, estate, gift, and trust tax returns, foundation returns, private partnership returns, and the list goes on. She's very well versed in this area, as well as buying and selling professional sports franchises. Very, very wide berth of experience. She was actually a manager there before returning to school for her doctorate. She earned her PhD, and she has taught at Old Dominion, Texas A&M University Commerce, which I now believe is East Texas A&M, and Marist College before coming to Texas Women's University. So we're very fortunate to have her. She came in August 2020, and she currently serves as an associate professor in the College of Business. Her husband also earned his doctorate in accounting. His degree comes from the University of Scranton, and he teaches accounting at the University of Louisville. They have a very active family life, includes a lot of outdoor activities, swimming and fishing and hiking. Additionally, her family is obsessed with Lego. Dr. Burke has also spent a decade as a volunteer EMT and a paramedic. So what a well-rounded human being we have here. Dr. Burke, thank you so much for bringing this program to us, and I will turn it over to you.
Thank you, Shalise. As she said, I am a CPA, but I am not your CPA, right? So this is just general tax information, not tax advice specifically tailored to your tax situation. So let's just jump in. And if you have questions, feel free to just, ask away while we're doing this. Don't worry about interrupting. Just ask your questions while we're at it, right? So let's start with why we even care about taxes, right? So we're going to obviously be providing our money to the government. So we would like to know how much we're really paying and the hows and whys so that we can be better informed voters, citizens, and consumers, right? The government uses our tax system to encourage or discourage certain behaviors. Any ideas on some of those things? I won't put anybody on the spot tonight, right? We want to encourage people to buy a home, right? We think perhaps we are, better at investing, or we take better care of a house if we own it rather than renting, right? So the government says we want to encourage people to buy a home instead of renting. So we make mortgage interest and property taxes deductible, right? So that reduces your overall tax burden. We're actually subsidizing your home ownership, right? We encourage donations to charity by making those deductible as well. Why do we do that? We want to encourage you to give money to charity so that the charity can provide services for the citizens rather than making the government provide those services, right? So to the extent that a charity is doing it, the government doesn't have to. Right? We can also use things like tax deferred or tax advantaged savings vehicles like retirement accounts to help us reach our goals, right? Having more money to save for a down payment or save for retirement, right? Again, the more you save for retirement, the less the government's going to have to support you when you retire. So it's important that we understand what's going on so that we can use the system to our advantage, right? I've always wanted to be an accountant, but I didn't decide I wanted to do taxes until I was an undergraduate student. And that's when I realized that doing taxes is really like a chess game against the government, right? And so that's what I love about taxes. And that's what we want to do here at the end, right? We want to make sure we use the system to our advantage. So we need to know the rules and know the system so that we can work within that to provide the best results for ourselves, right? So it's really pretty important that you understand what's happening with our overall tax system, right? So one of the things we really need to understand are all of the types of taxes that we actually pay. This is going to help us make better informed decisions. It also helps us evaluate the overall fairness of our tax system, right? We have income taxes. So to the extent that we have income, right? We go to work, we have wages, we're going to pay tax on that, right? And that's that one we pay, April 15th to the federal government, not to the state of Texas, but a lot of the other states, right? We're going to pay the same thing. That's our income tax. We also have payroll taxes. This is what some people call FICA taxes, right? Our Medicare and Social Security taxes. So when we have wages or salaries, specifically that payroll piece, we're going to pay some extra taxes on that, right? We have sales tax. Every time you go to the store and buy something, right? You go to the dollar store when it used to be $1, right? You think you're buying one item, it's going to cost $1. You get to the cash register and it's $1.09, right? That extra 9 cents is the sales tax that we're paying. We also have something called excise taxes. These are sometimes called hidden taxes or sin taxes, and they're a lot harder to see and feel. So an excise tax is sort of like a sales tax, but it's already built into the price of the good you're buying. So when you buy gas and the price always ends in that in 9/10 of a cent, right? Part of that is because of excise taxes, right? That tax is built into the price of the gasoline. If you go and buy beer or liquor, right, there's a tax that's built in there, right? And again, we call that thing our excise tax. We get taxed for owning things, right? We were paying sales tax when we bought it. Guess what? You still pay tax when you own things. We have real property taxes. That means a tax you pay on the house that you own, right? We have personal property tax. That's the tax we pay on all of the stuff that is property that is personal, right? What the heck does that mean? We're accountants. I will tell you, we're not creative, right? We say things like, air filters filter air. We do the same thing here in accounting, right? Personal property taxes. So it's property, some sort of asset that we own, and it's personal versus the real estate, right? Real estate was just land and buildings. This is all the stuff that we own that can move around. So we don't pay personal property taxes on everything that we own, just the things that are easy for the government to track. So cars, boats, RVs, those sorts of things, right? So again, we're going to pay tax when we earn the money through income tax and payroll tax. We're going to pay sales tax when we buy the thing. And then we have to pay tax again every year on our house, on our cars, on our boats, right? So we're paying an awful lot of tax. So it's really important that we understand what's going on there. At the end there, we have some of the others, right? Tourism taxes. Those are things like hotel taxes, rental car taxes, taxes that you pay on the tickets you buy to Disney World, right? A tourism tax. We also have things like estate and gift taxes. If you're really wealthy and you die with assets and you've managed to not have to pay tax on any sort of gains on that, you're going to pay tax when you die, right? So we're never going to escape tax. So it's, again, really important that we understand what's going on here. Because of all of these types of taxes, right, the income tax is something we call progressive. The more money you earn, the higher the tax rate goes, right? And so people will tell you, oh, we think the system's really fair, right? Because we have these income taxes and people at the high end, Bill Gates, right? He's paying a much higher rate. Well, he's got some beneficial income that actually has a lower tax rate, right? So maybe not. Additionally, what happens? We have payroll tax. If you're a low to mid-income taxpayer, what happens? Well, most of your income, for a lot of people, 100% of your income is from wages and salary. So on 100% of your income, you're going to pay income tax and you're paying payroll tax. If you're Bill Gates, what happens? Well, he's going to pay income tax and maybe at a higher rate, but maybe he has capital gains or qualified dividends, so he's getting a lower rate. But when it comes to payroll tax, right, most of his earnings are coming from investments, not payroll, right? So only a little piece is getting subject to that payroll tax. We have sales tax. Again, what happens if you're a low to mid-income taxpayer? You're going to spend something like 100% of your income, right? You're not doing a lot in the way of savings. So maybe almost 100% of your income is being subject to sales tax, right? What about Bill Gates? He's saving an awful lot of his money, right? So he's not paying sales tax. on 100% of his income, right? Same thing with excise tax. It's going to make up a much larger portion of our overall income than it does for, again, somebody like Bill Gates. Now, real property tax, personal property tax, right? His property is going to be valued much higher than my property, right? So his real property tax bill is higher. But again, not all of his assets are tied up in owning real estate or personal property, and not all of it here in the US, right? So we may see that our tax structure overall is regressive, meaning people at the bottom are actually paying more tax than the people at the top, right? So again, it's really important to understand the whole system to really be able to evaluate that idea of fairness, right? So again, we started with income tax. We're going to tax you on everything that you get in the year. That's earned and unearned. What does that mean? Well, earned is I go to work, I get paid a salary, I earned that money. Unearned is that investment portfolio, right? I have money sitting in a brokerage account, I'm earning, interest on bonds, I'm earning dividends on stocks. That is the unearned piece, right? And I'm going to pay tax on both of those, right? I may also have gains from, selling assets, right? So earned and unearned income, right? It's all going to get taxed. And we're going to tax that at the federal level, right? The US government's going to tax that. Here in Texas, we're not seeing that tax, but in other states, we're going to see that income tax is assessed at the state level. And in some states, they also assess tax at the local level. So you might have 3 levels of income tax on that same item of income. Now, we're not going to pay tax on 100% of our income, right? We have something called a standard deduction, or you might take something called the itemized deductions, and that's to reduce your taxable income, right? If you earn a small enough amount, right, you won't pay tax on any of that, right? Because again, we're going to subtract out this standard deduction, which says, right, again, there's this piece where we think you don't have the wherewithal to pay any of that tax, right? So the standard deduction is going to reduce that. And again, you may have something different, which we call itemized deductions for, again, things like owning your home, making charitable contributions, medical expenses, right? There are certain expenses that the government subsidizes, right? That means we're reducing the after-tax cost of engaging in those activities. Now, I've used words like progressive and regressive, right? Here is our income tax bracket for single filers for 2024, right? And that was a whole lot of tax technical words, right? So let's break this whole thing down and talk about what all of these words mean, right? So progressive means the higher the base, in this case, income, right? The more income you have, the higher the tax rate. So if we have not a lot of income, our tax rate here is 10%. When we have a lot of income, the rate is 37%. Now, 37% sounds like a lot, right? But this is actually a really low tax rate. In the 70s, this thing went up to the 90% rate, right? It was much, much higher than it is right now. So in current times, we're at sort of excessively low tax rates, right? So again, we're generally operating on pretty low tax rates right now. So what does this mean? Well, let's say we have income like right here at $100,525, right? What does all of that mean? Well, a couple of things. One, we needed to know our filing status, right? And we'll talk about filing status in just a second. So we knew our filing status, we're single. That just means we're not married. And we're going to go here and it says 22%. Right? So does that mean that I pay a tax rate of 22% on all $100,525 that I've earned? And the answer to that is probably going to be no, right? This is taxable income, so I get to subtract out that thing called my standard deduction, right? I have some other things to reduce this, but let's say I've earned more than that, I've deducted everything, and this is actually my taxable income. Again, am I going to pay 22% on all of that? If my boss says to me on, December 31st, I really need you to stay late and I'm going to pay you an extra $100 to work this extra hour at the end of the day. How much additional tax do I pay? Does that mean I pay 22%, because that's where I'm at right now. So I'd pay an extra, $22. Does it mean because that's going to bump me from here to here that I'm going to pay $24 in tax? Or does that mean that everything is now subject to tax at 24%? So if we were paying tax at 22% on everything, right, our total tax would have been $22,000 and some change. And now we're saying that it's going to be 24%. So now I need to pay $24,000. So that would mean that I got an extra $100 from my boss, but I owe an extra $2,000 in taxes. That cannot be right, right? That just doesn't feel right or seem right or sound right. But you'll see that lots of people make this same mistake, right? And they'll say, oh, I don't want to work overtime and make an extra $100. I'm going to owe so much more in tax. Now I'm going to owe $2,000 in taxes and I'm only getting paid $1,000. And that is not how this works at all, right? So we have these brackets here, and that's going to say for this first 11,600, we're only going to pay 10%. We're going to pay 12% on that next bit. We're going to pay 22% on the next little bit. And then that last $100, we will pay at 24%, but it doesn't like retroactively make everything taxed at 24%. Right? So let's say we have $150,000 of taxable income. Again, that put us in that 24% bucket. So again, people sort of incorrectly believe here that 24% marginal tax rate means I need to pay $36,000 in tax, right? And again, that's not what it means if we have a progressive tax rate. So what does that really look like? Well, on the first 11,600, right, we only pay tax at 10%. Then what happens? We have that 12% bucket, right? So for that next 35-ish thousand, we're going to pay tax at 12%. Then the tax rate goes up to 22%, right? So for the next 53,000, we're going to pay at 22% on just that bucket, right? And then that last little bit, we're going to pay 24% on that last roughly $50,000, right? So in total, our tax is $29,000, right? So we've earned $150,000. Our total tax here is $29,000, and our average tax rate is 19%, right? So our marginal tax rate, that's this MTR right here, MTR, marginal tax rate. That means that bracket that we're in. So when you hear people say, oh, my marginal tax rate is 24%, that means that's the bracket we are in right now. If I earned one more dollar of income, I would pay 24 cents of tax, right? Again, it doesn't mean on the whole thing. So again, my average rate here is 19%. When you talk about doing something like tax planning, you're talking about saving for retirement or, switching up investments, whatever it happens to be. When we are talking about tax planning, we need to use this thing right here, that marginal tax rate, because that's where we're operating, right? If the income changes some, it's changing at that 24% bucket, right? It's changing within this last bucket here. So this is what we use for planning. We use that average rate to talk about fairness, right? How fair is this if I'm paying tax at 19%? Well, guess what? Somebody like Warren Buffett, who doesn't have much in the way of, wages or salary anymore, almost all of his income is coming from investments, and most of that gets taxed at preferential tax rates. So Warren Buffett may only have an average tax rate of 15%. I'm here earning 150,000 and my average tax rate is 19%. And Warren Buffett has an average tax rate of 15%. So when we get to April, tax returns are out, and the social media and the newspaper articles or online press articles are all talking about how Warren Buffett talks about his secretary has a higher average tax rate than he does. This is what he's talking about, right? He has some special reduced tax rates to encourage investment. So his average tax rate is a lot lower than, again, in his case, his secretary's tax rate, right? And this is what we're talking about. Right, so again, our progressive tax rate, the whole thing not getting taxed at 24%. Now, if we earned $150,000, what happens? Well, we actually have that standard deduction, the $14,600 this year. So my taxable income is only $135,400. So again, those buckets still apply here, right? But at the end, my bucket is a lot smaller, right? Because I've reduced almost $15,000 of taxable income. So really now my total tax is about $25,500. We would actually still divide by 150, right? Because I earned 150,000. So really my average tax rate is getting a little bit lower. It's really closer to 17%. Again, still probably higher than Warren Buffett's, right? So a little bit problematic there. Now, how do we tell the government about this? We're going to file something called a Form 1040. It is due on April 15th. Now, you can ask for an extension. So the extension is an extension of time to file your tax return, not to pay the taxes you owe. So all of the money you owe has to be in by April 15th, but it might take you some extra time to figure out all of the paperwork. So you can ask the IRS for an extension until October 15th. Again, that's an extension of time to file, not an extension of time to pay. All of the money needs to be in by April 15th. Now, what do you do if you don't even know where to start? Find a helpful resource. That might be a VITA site, right? That's a volunteer income tax assistance site, usually run by the United Way, right? Denton United Way has one. There are some IRS free file resources, and there are some websites that will link you through from the IRS to other free online softwares. So the government has required, the TurboTaxes of the world to provide some free online software. Now, a number of those, if you happen to live in a state other than Texas, will then charge you to file the state. But if you're here in Texas, we don't need to do that anyway. So a number of those resources are pretty helpful, right? So IRS free file, the online stuff, you're going to input the information on your own. To complete that 1040, it's normally just going to ask you questions rather than asking you to put a bunch of numbers on lines on the forms, right? So it's just going to be like a little interview with the computer. You're going to tell it information. It's going to fill everything out. If you go to the VITA site, there are people there, volunteers. We're going to take the information from you, ask you some questions, and they will take care of filling all of that out for you. An additional excellent resource if you're trying to do this on your own is Publication 17, and you can just get that from the IRS website, irs.gov, and just do a quick search for Publication 17 or go to Form and Publications and look for 17. This is going to be a publication called like Your Income Taxes, and it describes in something a lot closer to plain English what the heck you're supposed to be doing, right? The 1040 has form instructions, but it sounds very like tax technical, lawyery speak, right? Publication 17 is going to be much closer to plain English, describing what the heck it is you need to do. That is going to be useful even if you're not trying to file your tax return, right? If you're like, I'm going to take this new job, it's going to be a side hustle, right? Like I'm going to work for like DoorDash, I'm going to get paid as a contractor. I have no idea what that looks like. Publication 17, the place to go, right? So Pub 17, excellent resource for you there, right? So who the heck needs to file? This in nice table format isn't out for 2024 yet. So we have the 2023 one here, but generally it's just slightly higher each year, right? It just increases by a little bit each year. So it's relatively close, right? So if you are single, and again, we're going to get to filing status here on our next slide. If you're single and your gross income is, call it about $14,000, right, for 2024, then you're going to need to file a tax return, right? Now, does that mean if you earn less than that, you should never file a tax return? Probably not. I would go ahead if I had wages and I've had income tax withheld. So if I earned $10,000, right, I had a part-time job, I earned $10,000, and they withheld income tax, I probably don't owe any tax, right, because of the standard deduction. So I'm going to file that tax return anyway to get all of my withholding back. I'm not giving the government money that they aren't entitled to, right? So I would file the tax return to get that back. So this is when you have to file a tax return. Below that, if you have any withholding, I would highly recommend that you go ahead and do that, right? So make sure that you get that money back. I would also recommend doing it if you qualify for something like the earned income tax credit. So you're working, you have qualifying dependents, you're going to get something called a refundable tax credit, which is basically going to make a negative tax. I would file then to get all of that back. You may also want to do this if you qualify for the additional child tax credit. Again, extra money that you're getting back. Also qualifying for something called the American Opportunity Credit, which is an education-based tax credit, right? So there are other reasons to file. So again, filing status. What the heck does this mean? This is talking about your marital status on the last day of the tax year. So you could be single for the entire year, decide that you are getting married, on New Year's Eve. So December 31st, you're going to get married. You're actually going to file your tax return, married filing joint or married filing separate for the entire year, even though you were married for, like 2 hours of the year, right? So marital status on your last day of the tax year. Single means you are not married. You could be divorced, etc., but single. This is kind of the default status if you aren't anything else. Married filing joint, again, on the last day of the tax year, you are married, you are going to file this tax return together. Most married people will file this way, married filing joint. The downside of this is what we call joint and severally liable. What the heck do those words mean? Right? That means that my husband there, if we file a tax return together and he has a whole bunch of income he didn't tell me about and it doesn't end up on our tax return and we owe a whole bunch of money to the IRS, they can come after me for the entire amount, even though it's not my income, it's his, right? They can come after me for the entire amount because again, we are joint and severally liable. I'm on the hook for all of it, right? Now, there are some benefits to being married filing joint versus married filing separate, but again, there are some risks with doing that. Married filing separate would then mean, of course, that you are married, but we're going to file 2 separate tax returns. We are going to take away some benefits from you when you do this, right? So be very, very careful if you're going to talk about doing married filing separate. We also have something called head of household. Now, this is a taxpayer who is unmarried, right? So you're thinking like they're unmarried, they should be single. But these people, these taxpayers, paid more than half the cost of running or maintaining a household, and they had a qualifying person living with them for more than half of the year. Now, if that's a qualifying parent, they don't have to live in the house with you, but you do need to be supporting them. So if you had a parent that you are supporting, and they live in a nursing home or they even live by themselves, but you're still providing the support, they are actually a qualifying person for you, and you can use this head of household status. Normally this happens, because you're unmarried and you have a child living with you or a grandchild or a brother or sister, right? Again, your parents could count here. Head of household gets more benefits than single, right? And that's because we talk about wherewithal to pay. And the government says, if you're single and just supporting yourself, you have a higher or greater ability to pay tax than if you're unmarried and you're providing for other people as well, right? So head of household is going to have some more beneficial options than filing as single, right? And then we have a qualifying surviving spouse. So that is if you were married, your spouse died, and you have dependent children living with you, you can actually be essentially married filing joint for a couple of years after their death. How do we know here's a question. How do you know how much to pay on April 15th if you receive an extension to file until October 15th? You have to essentially put together almost all of your tax return, all of the information that you know, and you make your best guess on the pieces that you don't know. So if you're waiting for somebody to provide you some information, you need to get your stuff together for DoorDash, you don't know what number to put in, you're going to put in your best guess as to what that number is and use that to pay your tax so you can get that extension, and then you have more time to get the paperwork all right. So that's sort of how you know how much to pay for April 15th to get that extension. Your best guess. So I suggest putting in everything that you do know for certain, right? You have a W-2 from your employer for your wages, right? You put all of that in. And then again, you sort of best guess on everything else. Excellent question, though. All right, dependents. We keep talking about things like head of household and right, having qualifying people or having dependents. We used to get a deduction for each dependent, and that was because the government said you couldn't really pay more in tax if you had to support a whole lot of people. So we, like the standard deduction, had these personal and dependency exemptions to reduce your taxable income. That doesn't exist anymore, right? But we still need to know this because it helps us determine our filing status, right? Are you head of household? It's going to help us figure out some of our tax credits, right? We can take some credits for some of our dependents, child care credits, right? Those sorts of things. So our dependents always have to be a U.S. citizen or resident of the U.S., Canada, or Mexico. They can't be filing a joint return. There are obviously some exceptions to that. And they need to be something called either a qualifying child or a qualifying relative. So let's talk about these two things. We have this qualifying child, which is, again, sort of what it sounds like, a child who qualifies you for certain tax benefits. So first we have to meet this relationship test. They need to be your child or descendant. So that means your child, your grandchild, your great-grandchild, or your sibling or the descendant of a sibling. So your brother or sister, and then their descendants, so their kids, so your nieces or nephews. So for qualifying child, my kids, my grandkids, my brothers and sisters, maybe, and my brother and sister's children, so my nieces and nephews. These people need to meet an age test. So that says they need to be younger than me, and they need to be under 19 or under 24 and a full-time student, unless they are permanently and totally disabled, in which case the age test does not matter. They need to meet something called the residence test. They need to have the same residence as the taxpayer for more than half of the year, right? So divide by 2, add 1 day, right? So more than half of the year. This here becomes problematic sometimes with divorced parents. We can actually have in a divorce decree or a child support agreement who gets to claim the child. So even if the other parent has the child for more than half of the days, you can still actually do this. But again, it then needs to be in that child support agreement or in a divorce decree. And then the last one is the support test. The child can't provide more than half of their own support. So that means that if we're strictly looking at the residence test, they live with you for more than half of the year, but your co-parent provides more than half of the support, right? They provide a lot of financial support. That's okay because the child is not providing their support, right? So this doesn't say you have to provide more than half of the support, just that the child can't be sort of self-supporting. There are some tiebreaker rules if we have parents who can't figure it out and didn't think to include this in a divorce decree. We also have somebody called a qualifying relative, right? Before I said something about maybe you're supporting your parents while they're living in a nursing home. They can be what we call a qualifying relative. So here we have a relationship test again, but it looks a little different. Here, these are descendants or ancestors, siblings, nieces, nephews, aunts, uncles, right? So we can go up and out. This is a really big tree. The last relationship tree was like really narrow, right? We were going like right down a trunk. Here we're like, how about everybody except for our cousins? Cousins don't count, but your aunts or uncles do. I also want to point out that for tax purposes, when I talk about qualifying relatives, somebody, once they become your relative for tax purposes, is your relative forever, right? So if you get married and you have a terrible mother-in-law and you get divorced, for tax purposes, your mother-in-law is your mother-in-law forever, right? They actually meet the relationship test in perpetuity, right? So divorce doesn't sever that. But the relationship test here, no cousins. However, we have this really crazy thing when we talk about a relationship test. Somebody who lives with you for the entire year, even if they are not related to you, counts for the relationship test. So your cousin, if they live with you for the entire year, they actually can become a qualifying relative, right? So the relationship test, really big tree, plus anybody who lives with you for the entire year, right? The other people, they don't have to actually live with you, right? There's no test here that says that that person is living with you, right? You don't see the residence test here, right? So your parents, your aunts and uncles, they don't have to actually live with you to be a qualifying relative, right? And then our support test now, right, when we talked about qualifying child, we said the child can't provide more than half of their support. Here we're saying you, the taxpayer who wants to claim this person, you need to provide more than half of their support. The gross income test here says that that person needs to make less than about $4,700. So your parent living in the nursing home, they are related to you, no worries about residence. You are providing their support and they're making less than $4,700, you can call them a qualifying relative, right? And that could make you eligible for head of household. What are we learning from all of this? That this is really hard. And if this is something that happens to you, like this is your tax situation, that you maybe have a qualifying relative, or you're not sure if you have a qualifying child, you should probably get some help, right? Go to VITA, use one of those free tax services that's going to ask you all of the questions to try to walk you through whether or not you have a qualifying relative, whether or not your child qualifies, right? It's a lot of tests to remember, right? There's a lot of information here. Taxes change every year, sometimes more than once per year. Get help, right? That's why there are free resources around and available. All right, let's talk about having kids. We have some benefits here for having children. There's the child tax credit. We're going to give you a $2,000 credit per child. Credit for other dependents. This is where we're talking about some of those qualifying dependents, $500 for each of them. We have something called an additional child tax credit. I call this refundable. That means it can basically create a negative tax. It's part of this $2,000. We have a child independent care credit that says if I'm having to pay for childcare while I'm working or I'm attending school full time, I can take a credit to offset the cost of paying for daycare, right? So again, that's the government saying we're going to subsidize daycare, reduce the cost for you because we want you to work or be in school, right? So we're encouraging certain behavior here. We have the earned income tax credit. This is actually a refund of some of those payroll taxes, right? And then having kids can qualify you for that head of household, which again has some beneficial tax rates to it, right? So there are tax benefits to having kids. Don't have kids because of the tax benefits, right? They cost way more than any of the tax benefits you get, right? They're way, way more expensive than that. So don't do that just for tax purposes. All right, shifting gears, side hustles. We're working for DoorDash, right? What the heck happens here? We need to report all of that income on something called our Schedule C on the 1040. You might get a 1099 from DoorDash. If you don't, if you're, doing hair in your dorm for all of the people who live on your floor and they're paying you, we're gonna, not talk about licensing and needing to be, licensed beauticians or whatever, but we're doing something to earn some income, right? We're not going to get a 1099. We actually need to report that on our Schedule C. We do, however, get to deduct the associated expenses. So we get to offset that with any of our business expenses. So if you're having to buy, like for DoorDash, the pizza warmer bags, you have lots of mileage, some gas, right? You have lots of expenses that go with that, car insurance, wear and tear on your car, right? We get to deduct all of that. We may need to pay something called self-employment taxes, right? And these things here are equivalent to the payroll taxes we were paying when we had wages and salaries, right? So we were paying FICA and Medicare, or Medicare and Social Security. We have to do that when we're self-employed, right? Have that Schedule C. So we're going to have to pay self-employment taxes. What does this mean? We probably don't have enough withholding, right? Our boss takes money out of our paycheck each week, each month, whatever we get paid, and they send that to the government on our behalf. When we're self-employed, that's not happening. So you want to make sure that you are making those estimated tax payments. So that means every 3 months, right? Once a quarter, you want to be sending in a check to the IRS covering about 25% of your remaining tax bill, right? So when you are doing something like working for DoorDash, we need to make estimated tax payments if we are going to report net income. So you should get a 1099, 500 and up, it's 600 and up. But yes, if you have certain places, some places are not so good about sending you a 1099 at a $500 or $600 threshold. Others are going to send it to you at $100, right? So 1099s are sort of hit and miss. Can your business expenses deducted be greater than income from the business? Yes, you can report a loss from your business. Now, be careful when that happens. The IRS may come back eventually and say, you're not actually in business. What you have is what we call a hobby. So if you are consistently reporting losses, you're going to want to make sure that you have enough documentation to prove that this is a business and not a hobby. But yes, you absolutely can report a loss from this. So your expenses can be higher than your income. All right. Scholarships. Another thing that, we want to know about. Scholarships are generally going to be tax-free if we use them to pay for our tuition and fees, anything required to attend class, and things like books and supplies, equipment, right? If you have to buy like lab equipment or whatever, that's all going to be tax-free, right? So I take my tuition dollars, I use it, or my scholarship, I use it to pay tuition, I use it to buy books, I am good. Now, those amounts are going to be taxable if I use it to pay for my room and board or travel or optional equipment. So if you sometimes wonder why faculty list things as like required for a course, and then they're like, hey, that's really optional, this is why, right? So when it's up here in that required list, right, equipment required, then you can use your scholarships to cover that without making it taxable. So it is taxable though if it goes to room and board, right, to pay for your dorm room or your meal plan. It's also going to be taxable if you are required to perform services in exchange for that scholarship. So if you get a scholarship and you are required to be, a resident advisor in a dorm, an RA, you're required to be a GA as a result of receiving that scholarship, then it becomes taxable. If you get an athletic scholarship and you have to give that all back if you get injured and can no longer play, you're required to perform services, right? So that becomes taxable. Now, if you were an athlete and you were awarded that scholarship and you get injured and you can't play the rest of the season, but you don't have to give up your scholarship, it's still going to be tax-free, right? So if you have to perform those services in exchange, the scholarship becomes taxable. We have some other education tax subsidies. You get to take a deduction when you pay student loan interest. Boo, right? But at least we're going to subsidize that a little bit. We have some savings bonds. The interest is going to be tax-free if we use that to pay for education. So those are called Series EE bonds. So this question is, would volunteering count as one of the services you're awarded a scholarship for completing a certain amount of volunteer hours? So if the scholarship is because you previously did volunteer hours to qualify to be awarded that scholarship, no, it's if you have to continue volunteering to keep those scholarship dollars. Let's see. If you had one of those Schedule Cs, right? We were driving for DoorDash. If we are paying for related education expenses, so maybe not DoorDash, I don't know, maybe there's some sort of course on being like a great dasher, I don't really know. But if it's related to your job, you can deduct those expenses. If you're a DoorDasher and you're going to college because you want to be, I don't know, a biologist, right? That is not related, right? But again, if you're going to some courses on like how to be the best dasher, or you had lots of spare cash floating around and you have a real estate empire, right? And you're going to courses on real estate and, being a landlord, those courses would be deductible. Cancellation of your student debt is now tax-free. You used to have to pay tax on the income that was canceled there, on the loan that was canceled. There's now a subsidy for tax-free student loan repayment. So if your employer pays a portion of your student loan, gives you money to cover some of that, it can be tax-free. And then employer paid education expenses, that can be tax-free as well. So if you have an employer who's paying part of your tuition, that can be up to $5,250 a year, and you don't have to pay any tax on that. Where do job-related deductions go? They are also going to go on Schedule C right after all of your Schedule C income. So at the top part of the form, you're going to have all of your income items. Right below that, you're going to have all of your related job expenses. So you'll have Schedule C income, Schedule C expenses, net income from that Schedule C. That net income piece at the bottom, that's what you use for figuring out your self-employment tax, and that's what you're actually going to pay income tax on as well. All right, what else do we have for education? We have qualified tuition programs. These are 529 plans. The earnings in there are tax-free as long as you use that to pay for education. Tuition reduction, so if you have some sort of tuition remission, that is going to be tax-free. So if you're, a PhD student and they reduce some of your tuition, you're good there. And then we have 2 credits there, one for the first 4 years, one for everything after that. Another question here, what proof, if any, is needed to deduct an expense related to your business? You need some sort of documentation in case the IRS comes back and audits you. Our system is actually an honor system. So technically you don't need anything to get the numbers on the tax return. But if you get audited, you need proof. What does that look like? If you're buying gas, that's a receipt that you get at the fuel pump. If you're talking about mileage, we're just going to keep records as we do it. So if you have a contemporaneous documentation of some sort, that's going to be what you use to prove to the IRS your mileage. What the heck does that look like? That says that I, essentially keep a composition notebook in my car or some other sort of, documentation. And, on January 1st, I write, the start of the shift, the mileage on my car is 25,000 miles. At the end of the shift, it's, 25,500. So I have 500 miles today or whatever, dashing, right? And that was business related miles. The next day, right, I'm going to a football game. It's personal. I might write that down in, personal use. But even if I'm just logging the overall miles that I'm driving for the business, that's actually going to count. Obviously, if it's coming from somebody else, like the fuel pump, right, that is a much more convincing piece of documentation for the IRS if you get audited, right? All right, what else do we have? I want you to know about tax credits versus tax deductions. Credits are a dollar for dollar reduction in your tax. Deductions reduce your taxable income. So then the benefit there is going to be based on your marginal tax rate, right? If you have taxable income, it's $100,000, your average tax rate is 20%, you're paying tax of $20,000. If you have a credit of $5,000, what does that mean? My tax was $20,000, I subtract out 5, now my tax is $15,000. A tax deduction means that I reduce my taxable income. So it was $100,000. I subtract out 5,000 because that's a deduction, not a credit. And now it's $95,000 is my taxable income. I multiply that by 20%, and now my tax is 19,000, right? So when I had a deduction, I'm only saving tax of $1,000. When it was a credit, I'm saving the full $5,000, right? If I have a refund, that means the IRS is giving me money back on April 15th. That means I gave the IRS an interest-free loan, right? I gave the government an interest-free loan, and they're giving me back my own money in April, right? doesn't represent my total tax liability, right? It's just that they are giving me money back. So I know some people are like, yes, I got a refund, but do know that that means that you let the government borrow your money for the entire year without paying you interest. If that's your only way to save, maybe it's not a terrible idea, but you're better off not having large refunds, right? All right. Payroll taxes, right? Again, you need to pay this on your wages. Your employer is going to withhold some, you're going to pay some, right? So you pay half, they pay half, right? Medicare is about 1.5%. Social Security is 6.2%. So what does this look like? If I have wages of $1,000, I pay $15 roughly in Medicare. I pay $62 in Social Security tax. I also have that withholding, right? The federal income tax. So if I use like 5%, right, they're going to withhold $50 and now I'm getting $873. Well, I might also need to pay my health insurance, right? So this is my share of the premium. It's going to come out of my check, but guess what? That's getting done before tax. So there's a subsidy for that as well. So here you're seeing that my federal tax withholding went down. It did not help here, right, with my Social Security and my Medicare. It's not reducing that, just the federal income tax piece, right? Well, what else could happen? I could decide I want to save for retirement. So I'm going to put money in my 401k. So I'm going to put $250 in. That's also done pre-tax. So again, that's going to reduce that federal tax withholding, but again, not those payroll taxes, right? So that's not going down, but it is reducing my overall income tax. So to the extent that I save in my 401k or I'm paying my health insurance, I'm actually reducing my taxable income. If you want to know what that's going to look like for you, down here, there's a quick link that you can use to figure out what your take-home pay is going to be with all of your various deductions, right? Retirement plans. I want you to contribute to a 401k if you have that option, right? So what is this? It's what we call a tax-deferred savings vehicle. We're going to put money in. It's going to earn a return, interest and dividends, and that's not going to be taxed until retirement. So we get to put off paying taxes for like 40 years, right? And so that means we get to have more in our account because we're not paying taxes till the end, and the money that's in the account continues to earn more money, right? Additionally, our company might match that. So that's 100% return on my investment, right? If you make 100,000, you put 5% in, they're going to match that. I put $5,000 in. My employer immediately puts $5,000 in, right? I put $5,000 in and now my account is worth 10,000, right? That is huge, right? 100% match. IRAs are individual retirement accounts, gives me the option to do this on my own outside of my employer. Traditional means I'm going to take a deduction for that contribution now, right? But that means I have to pay tax on that in retirement. Roth is reverses. I don't pay tax. I don't take a deduction now, but in retirement, I don't have to pay tax either. If you think tax rates are going to go up for you, Roth is the way to go. So let's look at our friend, the 401k. Our grandmother here is going to give us $10,000 when we graduate. Super happy for us. We're going to take that money and we're going to put that in an investment account, and we're going to use all of the skills we've learned, and we're going to actively manage this, and we're going to get an awesome 12% return. Alternatively, we came here to this session and we're going to say, you know what, I'm going to put that in a 401k. My employer has a plan, $10,000 going in the 401k. But the options I have there, it's going to get a 10% return, so a little bit less. But I have a 35% tax rate. So what's going to happen? I'm going to warn you that on the next slide, there are a bunch of crazy equations. I don't want you to feel overwhelmed. You don't really need to know that. I just want to make sure you know like how we're getting to these crazy numbers. So what happens if I actively manage my earnings, right? I'm going to take $10,000, I put it in, it's going to earn 12%, but first I have to pay tax. So this says the tax comes out first, and then after I pay tax, I'm left with something less than 12%, and it's going to grow for something like 30 years. If I put this in the 401k, right, we want to be tax efficient, and I only earn 10%, what happens? Well, this is a pre-tax number, so we actually get this crazy gross up calculation here. which says we actually get to put in like $15,300. It then earns a return of 10%, and that gets to compound, and I don't have to pay tax till the end, right? So that's really what's happening here. That's the math behind this. So I can be a really good investor, and after 30 years, I have just under $100,000, right? I could use what I learned here, and I can put it in a 401k, right? And I have a little bit over 150,000 at the end of 30 years, right? Now keep in mind here, I'm talking about a single one-time $10,000 payment. And in 30 years, I have over $150,000, right? But why can't I do both? Why can't I be a really good investor and use efficient tax planning? I can do both, right? And at the end of the day, at the end of 30 years, right, I have almost $300,000. Again, that was from one single $10,000 investment today. In 30 years, I have almost $300,000 from that. Why is that? That's the magic of compounding interest. The key here is time in the market, not timing the market, right? I want you to do this. If you take nothing else away from tonight, I know it's hard early on in your career to sacrifice and have money going into your 401k and not have it to pay rent or for food right now. It is going to be so worth it to put that money in. This is just your $10,000. This isn't even that match coming from the employer as well, right? Because that would put an extra $10,000 in immediately, and then you have $20,000 putting in the account to grow for the 30-year period, right? So time in the market, not timing the market, right? That was all the math behind what we just did, right? So when you look at payroll, right, we have lots of benefits that are going to be tax-free. Early withdrawal penalties, yes, exist. I had an hour. Actually, we have like 45 minutes and we're already pretty close. So not talking about early withdrawal penalties on the 401k, but yes, there are some penalties for tapping into that early. But you can use it for things like there are ways to get money out for first-time home buyers and some education expenses and medical expenses. So there are some exceptions to that. But yes, otherwise, early withdrawal penalties. So benefits, you can have a number of benefits that are going to be tax-free. Your health insurance, something called a cafeteria plan, where they sort of let you pick from a variety of benefits they offer. De minimis benefits like making copies. No additional cost benefits, like if it's an airline and they let you take an empty seat. Dependent care benefits, so paying for childcare, those employer paid education benefits. Some of them do end up being taxable, so just be careful about that when you get started. So again, payroll taxes, you got to pay them. Even our tax-free benefits don't generally reduce those the payroll taxes. And then the big one, contribute to your 401k if you can. How do you tell your employer how much to withhold? You need to fill out a W-4. So when your employer asks you to do this, they're not just trying to like steal your social security number or anything. They just want to make sure that they get a good estimate for the amount that they need to withhold. So hopefully you don't owe a lot on April 15th when you file your tax return. I do have some slides on how a tariff works, because that's obviously pretty popular in the press right now, but I know we're at time. So I'll see what Shalise says if we can talk about tariffs, or if she's cutting me off.
Oh, no, you're good. Keep going.
Fantastic. Let's talk about tariffs, because tariffs are everywhere right now. So what are they? Tariffs are a tax on imported goods, right? So when we bring goods here into the US, we're going to assess something called a tariff, and a tax gets paid on whatever we're selling that to, importing that for. Now, tariffs can absolutely be useful tools to protect a domestic industry. So, for example, the steel industry, we had to assess some tariffs on imported steel. So we had domestic steel production, but because we've got unions and higher wages than in certain other countries, US-based steel cost more than imported steel, right? Because the imported steel they were paying lower wages in those other countries. We needed to protect our domestic steel industry to maintain those jobs. So we assess a tax or tariff on imported steel. And that tariff is enough to make up the difference in that price. So now imported steel costs the same or more as domestic steel. So the domestic steel producers are protected, right? They're not being undercut by those low wages bringing steel back, right? So again, tariffs can absolutely be a useful tool. Tariffs need to be sort of like a scalpel though, right? Rather than like a machete or a hatchet here. Typically, if we assess a tariff, there will be a reciprocal tariff, meaning the other country is going to assess a tariff on our goods going into their country. So US steel going into those other countries will now be met with a tariff there. So the domestic steel producers are going to need to be able to sell domestically, right? Because in those foreign markets, they were already undercut by the cheaper labor, and now they also have a tariff, right? So it's going to be doubly expensive in that other country. So that industry needs to be focused on domestic sales, right? So let's talk about what happens here. We have a manufacturer in China. They're going to make a shirt for $7 and they're going to sell it to a US importer for $10. The tariffs are based on this $10 number here, right? The importer is going to sell that shirt for $15. So the manufacturer is making $3 right now. Our importer is making $5, right? And the consumer right now is paying $15 to acquire this shirt. Now we're talking right now about tariffs of about 60%, right? Please know that tariffs are generally not in small percentages, right? We're talking about a 60% tariff. So we're going to levy a 60% tariff on the imported good. And again, it's on that $10, right? That amount that we were charging here to the US importer. That's where the tariff goes, on the $10. So we have a tariff of $6. Now for the manufacturer, what happens? It was costing them $7, and now they also need to pay a tax of $6, right? So the manufacturer, yes, is going to pay $6, right? They have to pay that tariff, right? And so now the shirt costs $13 for them to manufacture. Are they going to charge the importer $10? The answer there is probably not, right? They were making $3 and now you're asking them to sell it at a loss of $3. That's not going to happen, right? So what's going to happen? They're probably going to charge the importer something like $16, right? So the $10 they were charging before plus that $6 tariff. So now we said, I'm not paying the tariff. I'm going to move that to the importer, right? So now the importer is paying $10 for the shirt plus a $6 tariff. So now the importer has paid $16 for this shirt. Are they going to charge the consumer $15? Are they going to lose $1 in this? The answer, of course, is no. So what happens? Instead of charging the consumer $15, we're going to add in the tariff to that, and we're going to charge the consumer $21. So now the consumer is paying $6 more, right? They're going to pay $21 now instead of $15. So who paid the $6 tariff? The consumer. The manufacturer way up here 2 slides ago, they may be writing the check for the tariff, right? They may be the one like actually writing, $6 tax tariff check, right? But it's this consumer who pays. So the consumer either needs to pay the $6 tariff or they don't buy the good, right? So those are the options. Again, this makes sense if the domestic production, say steel, they already had to charge $21, right? And on the imported goods, they were able to, get away with 15 at the end of the day, right? We would assess a tariff there to bring that lower price good up to the same price as the domestic good, right? But we're not always doing that, right? So when we talk about tariffs more broadly, what are we talking about? Just assessing tariffs on everything, right? And that makes everything more expensive. The consumer ends up paying that. Again, there are also retaliatory or reciprocal tariffs So exporting goods becomes more expensive as well. So that's just a very brief, like, how the heck do tariffs work for all of you who, like, see it on social media and in media right now. So I added that in as just an extra bonus for today, right? So I'd say questions, we've been kind of taking them as we go. If you have questions, though, that you didn't get in, I'm always happy to take those now as well. If not, thanks for coming
Absolutely.
tonight.
Absolutely. Whew.
I know. I was talking fast. We need more than one. We need to separate it out, and we'll just talk about retirement plans one night, because I want everybody to have a retirement plan. I want everybody to put their money in a 401k.
Yes, I think that's a fantastic, and I know that that's something, especially for our upperclassmen. It should be for everybody, but for our upperclassmen and our grad students, we're getting that question as well. So yes, consider another meet with an expert with Dr. Burke in the spring.
Yeah.
Gabby, do we have any questions in the chat?
We got one more, which was, can co-pays be deducted? Can co-pays be deducted? Yes and no. Thing one, you have to be itemizing your deductions, which means your itemized deductions need to be higher than the standard deduction to do that. Additionally, we have an AGI, adjusted gross income threshold. Some years it's 7.5%, sometimes it's 10%. So again, let's say you make $100,000. Let's say we're in a 10% year. You can only deduct your medical expenses to the extent that they are more than $10,000, right? So yes, but this is tax. So there's always an exception to the general rule. Yes, but it depends. Yeah.
All right.
Other
And
questions
one thing I've always learned every time I listen to you, Dr. Burke, is about the taxes. And growing up, of course, everybody's like, oh, I got my tax refund. I'm going to be able to go take my kids on vacation or whatever. And then exactly what you said, it's an interest-free loan to the government. If you just put that money aside, a little self-discipline, a little good at managing money habit, you would have that automatically.
And then you can earn interest on it, right? You could invest it and make more money. Yeah.
Exactly.
You could upgrade, to the, like, cut the line pass at Disney World or something. I don't know. Upgrade your
Absolutely.
room, right?
I know. Well, that would be the goal. Absolutely. I know that one of the things is now I look at it, if I have to write a check for, say, $251 on April 15th, that's okay. As long as I know that I've planned for it and I have that set aside.
Keep it under $1,000. If you owe more than $1,000, you might have to make an underpayment penalty, right? So you might have to pay an underpayment penalty. There are safe harbors based on what you made last year. It's tax. It depends. But if it's under $1,000 that you owe, no underpayment penalty. So careful with that. $1,000 is your cutoff.
Okay. All right. Are there any other questions, comments? I hope you guys got a lot out of this. I know I always do. And I thank you, Dr. Burke. And I really appreciate you guys staying with us for going over time a little bit. But I just want to remind you that survey is going to pop up when you leave the meeting. Follow us on Instagram at TW Maroon Money. This is our last meet with an expert for the semester, for the fall, but
close it out.
We have a lot. Yeah, we're closing out strong because I can't believe we're already just, less than a couple of weeks from Thanksgiving and then the end of the term. So please, when you do the survey, if there's any specific topics that you want to have more of these sessions on, include that in your survey feedback. And I appreciate all of you. Dr. Burke, thank you very much again. You guys have a great evening. Thank you, Gabby. And we will talk to you guys later. Thanks so much.